So I actually have this software and I'm showing it to you right now. And so what this software tells me, this is the money calendar. This is seasonal opportunities. And what I've done is I've gone in and I've actually brought up just the S&P 500 itself. So it's showing me that, holding this particular trade or finding a seasonal trade like this and holding it for 43 days. What is it sharing with me here? What shows me in 9 of the last 10 years, buying SPY and holding it for 43 days has resulted in the following. We see 9 of the last 10 years, it has moved up between now and 43 days ahead. So if I'm going to take this information that I see here, I need a couple of things. Number one, I need the average time that it took to get there. I need that time. And so it's showing between now and the 2nd of September. Right. The second thing I noticed is it's about 4.5%. So those are the two numbers that I have to write down or I've got to remember as I'm looking at a chart of today. Here's a chart of the S&P 500 today. And so you can see here that since January, we did have a pullback. All right. We have pulled back. And then also you can see the big run up that happened from April to June. The pullback that happened, we had a 38 from floor to ceiling, all right? From the floor of the end of March to the ceiling at the beginning of June, and then the pullback, we pulled back 38% of this bullish move that happened in April, May, and the beginning of June. That's a healthy pullback, right? We look for that 38 to 62% pullback. That's a Fibonacci pullback, and it pulled right back on that number. Now, I want to take a look at where we are today, which is roughly 750. Based on the patterns I've seen in the past, I'm projecting that between now and September, right, first week of September, S&P is going to get up there to, around a 40-point move from where we are now. So that puts us at 790. So here's what I need to do. First thing I like to do is I like to look at the implied volatility on the S&P 500. And as you can see here, it used to be high. And it's come down, and I believe that number is going to get lower. Right now, it's our implied volatility is around an 18 on the S&P 500. I believe and the lows around 17. I believe this is going to get down into the 15 area, and I believe that's going to happen here over the next 2 months. So as we get into September, that number could be substantially lower, and that's good because if the volatility drops, then, because this is not parallel, the S&P 500 should be at new all-time highs. So let's take that information and let's look at some options. I'm not going to look at options that expire next week. I'm not going to look at options that expire next month. I want to look at the options that expire in September. Those are options that have 74 days to expiration. And I'm going to go all the way out here. And if you take a look at the at-the-monies, and the at-the-monies are going to be the 750s. I'm going to put those on the screen here for you right now. So take a look at what these 750 calls are going to cost. They are 22.5 by 22 or 2255 by 2274. So, okay. So we took a $75,000 instrument, and by buying one call option, we have the right to buy 100 shares of SPY, but still going to cost, or not SPY. Yes, SPY. Still going to cost us over $2,200 for that call. So how do I get that down to something that's more substantial? Well, first thing I want to look at is my projection. My projection was 790, right? So that's a conservative projection. So let's go see what the 790 calls are going to cost. So I come up here to 790, and that's a target. So if you see here, the 790s are 505 by 508. The problem with buying, now that's a $505 by $508. This is right down there around the $500 range, which is what we're talking about. The problem with buying the 790s for 500 is, what if we go to 790 and we get there and we don't go above it, but we get there by the expiration day? Then these could actually expire worthless. We could have been right on our projection, but because we bought out of the money options that were at our target, market could get at our target, and we don't see anything in real value there. So what we want to do is we want to use 790 as a target, and maybe we go down and buy something a little bit cheaper. So how about looking at the 780s? Well, the 780s are 786 by 790. Okay, that's great. Let's look and see what the here's 775s, 965 by 970. All right, let's take a look at the 775s for a moment. And so if I were to go in and actually look at a call option with the 775 strike, and I buy that, right? Now what I've done is I put together a long call option. And here's my 775 call with a September 18th expiration on it. Fantastic. That's well past the September 2nd number that we're looking at. So we're going to have a little time value left. But the problem I see is that, well, this is not $500, Tom. I can't buy half of an option, $500. How do I get this to $500? Well, by getting it, we can get it to $500. We can actually not only do that, but we can also reduce the break even. Because the break even, let's say this is $1,000, then I've got to get to 785 by break even. All right. So how do I get this down? And what we can do is we can use the original 790 strike. All right. So here's my original 790 strike. Remember that 505 by 508? What if we sold that? What if we sold that strike and we create now a call spread? Take a look at this. So here, now we're still long the 775 calls, all right? But we're also short the 790 calls. So you're buying the open 775 call and you're selling the open 790 call. And right now, right up the middle, if you split the bids and offers, right, it's showing a net debit of $462. All right, so what's my cost if I can get it for this? $462. What's my risk? The amount I pay for the spread and no more, which is also $462. The next thing is, what is my return? What's my objective? What's my reward, my maximum reward? Well, maximum reward is going to be the difference between strikes. That's 15 minus what you pay for it. So if we paid $5 for this, $500, and I can collect $1,500, all right, and my risk is 5. My reward's going to be the distance between strikes minus what I paid. So I actually have a potential, if I round this up, $500 risk, but $1,000 reward. That is a 2-to-1.